to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, this week's market wrap with commentary and analysis from Money Metals Exchange, the company named Best Overall Precious Metals Dealer by Investopedia.
Welcome to this week's Market Wrap podcast. I'm Mike Leeson. Coming up in a moment, we have an exclusive interview with Michael Pento of Pento Portfolio Strategies and author of the book, The Coming Bond Market Collapse. Michael weighs in on the growing global de-dollarization movement as foreign countries around the world are actively working to reduce their holdings of U.S. Treasuries and how they are simultaneously increasing their gold reserves in the process. Mr. Pento also talks about how recent action in the bond market is signaling a very real concern over the government's insolvency and inability to control inflation, which is being reflected in rising yields despite the Fed cutting rates, and how these developments could be very detrimental for the economy due to higher borrowing costs. Michael discusses that and how gold is the absolute and ideal store of wealth in this environment with Mike Meharry in another wonderful Money Metals exclusive interview coming up after this week's market update. And as a reminder, please download, like, rate, and subscribe to this podcast, wherever you consume this content. Well, it's been a wild ride this week in the metals markets. Gold has been all over the place in a highly volatile week, but is currently up about $100 since last Friday's close to check in at $4,115 an ounce, good for a 2.5% weekly advance. Silver has seen even more wild swings. The white metal was white hot midweek, having gained nearly $6 an ounce since last week's close and pushing briefly back above the $54 level before retreating. Silver currently comes in at $51.39, well off its highs from a couple days ago, but still good for a 5.8% gain since last Friday's close. Platinum is up a slight 0.5% on the week to trade at $1,563, while palladium is up 2.6% to come in at $1,435 as of this Friday midday recording. Well, there's been a lot of talk about Tariff $2,000 rebate checks this week. If they materialize, you should consider using them to buy gold or silver. It appears the Trump administration is serious about this proposal, although there are plenty of question marks. On Wednesday, White House Press Secretary Caroline Leavitt said the administration is committed to make it happen. We are currently exploring all legal options to get it done, she said, reiterating that the president made it clear he wants to make it happen, end quote. The rebate would likely be subject to an income cap. Treasury Secretary Scott Bessent floated sending checks to families with incomes below $100,000 per year. The rebate would likely require congressional approval. The tariffs aren't generating enough revenue to pay for the rebate. The Committee for a Responsible Federal Budget estimates that if the rebate is structured similarly to the pandemic stimulus, it would cost around $600 billion. That is close to double the projected annual tariff revenue. However, that doesn't mean the government won't send out the checks. It would be a politically popular move, and the federal government has shown no hesitation in borrowing more money when it wants to do something. So if the checks come through, what should you do with the money? One thing is certain. You don't want to hold those dollars for long because they will lose purchasing power every day. Of course, a lot of people will probably need it to cover bills and pay off debt. However, if you have the option of saving your windfall, you might want to consider putting it in gold or silver. Just think about where you would be today if you had bought gold or silver with your COVID stimulus. There were 3 rounds of pandemic stimulus totaling $3,200 for an individual. You got more if you had kids, but we'll stick with this simple number. The average gold price in 2021 was $1,800 an ounce. At that gold price, you could have bought 1.7 ounces of gold with your stimulus money. And how much would 1.7 ounces of gold be worth today, with gold now at $4,115 per ounce? Well, it would be worth $6,995. That represents a 129% gain in just 4 years. The average silver price in 2021 was $25 an ounce. At that price, your COVID stimulus money would have bought 128 ounces of silver. At today's price of $51.39, your silver would be worth $6,578, a 108% gain. Now you understand why I'm suggesting gold and silver might not be a bad way to invest your tariff rebate, should it come to pass. Of course, gold and silver may not go up that much in the next 4 years, but odds are it will go up because inflation is rampant and it appears the Federal Reserve is intent on cranking up the inflation machine. Meanwhile, on Wednesday, the Philadelphia Mint produced the final 5 circulating pennies. Now, the Treasury stopped mass-producing pennies months ago after President Trump passed a death sentence, ordering an end to the venerable 1-cent piece earlier this year. However, an unspecified number of pennies were struck with an omega symbol to signify that they are the last of their kind. The final 5 pennies produced in Philly were part of that batch, and they will be auctioned off next month. Trump passed a death sentence of the penny in an announcement in February, citing the rising cost of manufacturing the 1-cent coin. Quote, "For far too long, the United States has minted pennies which literally cost us more than 2 cents. This is so wasteful." Trump went on to say that he is going to rip the waste out of the U.S. budget, quote, "even if it's a penny at a time," end quote. According to the U.S. Mint, it actually cost 3.69 cents to mint and distribute 1 penny. In 2024, the Mint produced 3.2 billion pennies and lost about $85.3 million in the process. So what happened to the penny? Well, 1 cent has become virtually irrelevant in today's financial system. The greenback has devalued so much that the value of 1/100th of a dollar is approaching zero. It's worth about as much as the lint in your pocket. And how did this happen? Well, as stated earlier, it's because the government is destroying your money. Simply put, the government and its enablers at the Federal Reserve have printed the dollar into oblivion. The more dollars they create, the less each dollar is worth. And they have printed lots of dollars. Since 2008, the Fed has created over $8 trillion through quantitative easing alone. The results were predictable. Based on the CPI, prices have increased by over 713% since 1970. And keep in mind that the CPI doesn't even tell the entire story of inflation. The government revised the CPI formula back in the 1990s so that it understated the actual rise in prices. Based on the formula used in the 1970s, CPI is closer to double the official numbers. On the other side of the coin, pun intended, production costs have gone up due to this same inflationary pressure. Put into perspective, it's no wonder it costs so much more to produce a penny than it's worth. The bottom line is, every time you pick up a penny, it's a reminder of Uncle Sam's monetary malfeasance. Instead of actually solving the problem, for example, and the borrowing, spending, and money printing, your drunk uncle just shot the messenger and sent the penny to its grave. This isn't the first time the government has taken steps to obscure its monetary destruction. In 1982, the Mint removed most of the copper from the penny. Before that year, pennies were comprised of 95% copper and 5% zinc. As an aside, we actually sell these 95% copper pennies by the 34-pound bag here at Money Metals. Due to the rising copper costs, a result of inflation, the Mint changed the composition to 97.5% zinc with 2.5% copper plating. The government devalued silver coins nearly 2 decades earlier. Under the Coinage Act of 1965, signed by President Lyndon Johnson, the U.S. Treasury removed all silver from dimes, quarters, and half dollars. Instead, the government mints coins from composites with faces of the same alloy used in the 5-cent piece that is bonded to a core of pure copper. Today, you will sometimes hear coins minted before 1965 referred to as junk silver. In reality, we should call modern American coins junk. The demise of the penny is another example of the same phenomenon. When Johnson signed the Coinage Act, he insisted that removing silver would have no impact on the value of U.S. coinage. Quote, "The Treasury has a lot of silver on hand, and it can be, and it will be used to keep the price of silver in line with its value in our present silver coin," he said. Just a few years later, President Richard Nixon made a similar claim when he cut the final tie to the gold standard. He said, quote, "Let me lay to rest the bugaboo of what is called devaluation," and promised, "Your dollar will be worth just as much as it is today." Both men were lying. When you disconnect money from anything of tangible value, it's going to quickly depreciate. It's as certain as death and taxes. And that's exactly what happened. This currency debasement is ongoing. They killed the penny. What goes before the firing squad next? The nickel? The way things are going, it's only a matter of time. This is why you want to have real money, gold and silver. It will not be devalued by government action and can hold the value of your wealth over time. Well, now, without further delay, and for much more on the markets and the economy, let's get right to this week's exclusive interview with one of our very favorite guests.
Greetings, I'm Mike Meharry, and I'm joined today by Michael Pento of Pento Portfolio Strategies. Always happy to have you on the show, Michael. How are you today?
Better than terrific.
Oh, wow. That's a high bar. I don't know that I can meet that today, but I'm trying
to be as optimistic as possible as I see the middle class being flushed down the toilet, and as I see the buy and hold bag holders getting flushed down the toilet. So it's kind of like, and I see another round of helicopter money being proposed.
Oh, I know. Isn't that crazy?
I mean, it's hard to stay cheery, but I'm trying. I'm faking it.
Well, we can't. There are things that we can control, and there are things that we can't control. And I guess we are best off trying to control what we can. So, well, let's talk a little bit about the gold and silver market to kind of kick things off. We had a pretty healthy correction. And I don't think that was a surprise to anybody. We were kind of in that time period when you would expect a correction. But it's bounced back pretty quickly. And I'm wondering if the speed of the recovery that we've seen in both gold and silver over the last few days has surprised you.
Not particularly. It's a very nuanced kind of question, almost like a day trader's kind of question. And I'm not a day trader in the precious metals market. So I'm looking at Governor Moran, who wants to cut by a series of 50 basis points to destroy the dollar faster. I'm looking at the President of the United States, who wants to put in an obsequious sycophant, as I'm fond of saying, when Powell is terminated. His tenure expires, not terminated. His tenure expires in, I believe, May of 26. And I look at our debt and deficit situation. We're gonna give a dividend. I mean, usually when a company gives a dividend, it's from excess cash flow, right? And we have $38 trillion national debt, and we have a deficit of $1.8 trillion. So where in the hell is this dividend coming from? Well, can I tell you where it's going to be coming? It's going to be more borrowed money.
Yeah, absolutely.
So it's a fiscal and monetary nightmare. Now, gold and silver and platinum went vertical. They've corrected. They consolidated at a lower price, and then they're on the march, higher. They are extremely susceptible to liquidity crises. So if we have a crack up in the bond market, I fully expect the correlation to go to 1. And that includes AI, that includes energy, that includes gold and platinum and silver and palladium and soybeans. Everything goes to a correlation of 1, and they all get flushed down the toilet. The only thing that works are short-term treasuries, sometimes the U.S. dollar, sometimes for a short period of time, and shorts. So cash, treasuries, sometimes U.S. dollar, and shorts. Those are the only 4 things that ever work. And I want to reiterate, sometimes the U.S. dollar. It doesn't look like it's going to work this time. So you basically have a 3-legged stool. If you're not shorting the market, and if you don't have cash, and if you don't have bonds, you're going to get everything goes to a correlation of 1. You're going to get wiped out in a liquidity crisis. Now, I'm not saying that's what we're going right now. My model was pretty quiescent up until today. I have to run it after hours again, but we'll see. I mean, if the market starts to crap out. And I predicted this, so you have to understand. I'm not doing this ex post. This is ex ante stuff. I said the market is going to crap out because long-term bond yields are going to start to rise intractably. And if this is the beginnings of it, and again, I'm not saying it is. It could be, but I'm not saying it is. There's not a damn thing that our government's going to be able to do about it to stop it. What are they going to do? Are they going to come out and say, I'm going to print a bunch of money to help with the inflation problem? Are they going to send more helicopter money? Are they going to borrow more, trillions of dollars? Are they going to lower interest rates? What are they going to do? The only thing I think they're going to try, haven't got here yet, they're not even close yet, but they might just say, we are now going to follow the Bank of Japan's, and it didn't even work there, but we're going to do some kind of like cap in the benchmark. We say the benchmark 10-year Treasury note will not trade above 6%. I hear thou decree that I will print unlimited amount of money, and it's a big enough bazooka, like Mario Draghi said. And go ahead, try me. And then the bond market might say, okay, we're going to try you, because it's not. They have to buy. They don't just have to buy treasuries. They have to buy municipal bonds too, right? Because if inflation's right, let's just say inflation's running 15%. Let's do a thought experiment. Inflation's running 15%, but the government's buying 6% bonds. Well, they'll be the only one buying bonds. Everybody else is going to be selling everything to them and shorting. They're going to be shorting unlimited amount of bonds to the government. But who's going to buy municipal bonds at 6% if inflation's double digit? Who is going to buy a corporate debt at 6% when inflation's double digits? Nobody. So I guess government's going to buy all that too. And then we'll just buy everything. And then we'll be Zimbabwe. I mean, it's not like this has never been tried before. It has, and it's always failed miserably. And I expect the same thing to happen again, because we've lost, Michael, we've lost our freaking minds.
There's a couple of things in there that I kind of wanted to touch on. Let's start with the Fed. You mentioned the likelihood, well, not the likelihood, we will have a new Fed governor come next year. And we've got some folks on the board right now that are talking about, 50 basis point cuts, as you mentioned. I want you to try to help me make sense of this. I can't. Well,
if you're going to ask me to try to justify a series of 50 basis point rate hikes when inflation's been above 2% for 4.5 years, I can't. But we'll see where you go.
Right, no, that's exactly where I was going, because and I'm asking it really more as a rhetorical question, because it doesn't make any sense. We have what is obviously still elevated inflation, and we're in an aggressive, I would call it an aggressive cutting cycle at this point. And they're talking about ending balance sheet reduction, and I think they're going to go back to QE pretty soon.
No, they already are. So QE is going to end officially in December. But the balance sheet is now growing. It's no longer shrinking. That is, by the way, how you get the interest rates. The Central Bank of the United States doesn't say, I decree that the Fed funds rate shall now drop by 50 basis points. Well, they don't do that. They print money, credit, they flood the money markets, and the interbank lending rate goes down because it's flooded with reserves. That's how they do it.
Right.
You know that. So, yeah. I mean, they're creating inflation. Credit is money, and that leads to more lending and more inflation. And if it goes out to helicopter money, they bypass the banking system. So you don't hope that the banks get money like we did in 2008. We lend banks money. We take their bad assets. We lend them money. They have credit, so they remain solvent, but they don't have to lend it out. They could just trade stocks and bonds with that money, and they don't have to lend it out. So we don't have a broad-based expansion of the money supply. But if we're sending helicopter money out, well, the money goes right to people. It has to go to people because that's where it starts. So they're sending checks to people.
Right. And that's exactly. I mean, they're already talking about doing that, right? With the tariff rebates that you've already mentioned.
$2,000 per every. So if the way the math works on that, I believe it's everyone who's making under $100,000 a year gets $2,000, and that comes to $300 billion. And we've taken in a little bit over $100 billion in revenue.
Yeah.
So it doesn't make any sense.
Yeah. And
when the president, who I supported and voted for, so please save your emails, when he says, well, we're gonna balance the budget and then we're gonna pay down the national debt.
With what?
What are you talking about?
Yeah.
I mean, the national debt is skyrocketing, and the deficit was $1.8 trillion. So that's how much is added to the national debt every year. So what dividend are you giving to people? Where's the money coming from? It's very aggravating. And when he says, well, inflation, there's no inflation anymore. Well, okay, inflation was. Let me just give you a minute of truth about, and a lot of people will agree with me on this one. So the level of prices has bankrupt the middle class. Mm-hmm. The lower 3 or 4 quintiles right? So the lower 60 or 80% of the population is struggling to make ends meet. That's evident in all the earnings reports that you see. They just don't have any money anymore. It's the level of freaking prices. So that's inflation is embedded. People can't afford a house. They can't afford health insurance. They can't afford to pay their taxes. They can't afford to eat properly. Okay? And then the level of inflation goes from 9%, the way they calculate it, to 3%. Now, that's on a second derivative basis of a drop. But prices are still rising by 3% on the first rate of change.
Right.
So the level of prices is bankrupt people. It's still rising way above, 50% above their asinine 2% target. So how does that equal no inflation? And what we're going to do now is print more money and send out helicopter money and send out a round of helicopters, get the helicopters going again.
Yeah. I tell people all the time that inflation is the plan. I mean, there's never no inflation. They're just trying to keep it at a point where people don't get too upset about it, I think is the strategy that they've got going.
Michael, you're exactly right. Exactly right. Because I'll give you a little secret. I'll give you a little inside baseball here. You should probably know about it anyway. So the Federal Reserve doesn't give a rat's patootie about the American people. And when it comes down to it, they care about one thing only. In the first and foremost, in the vanguard, is they care about banks. They care about the health of banks. And in the second, an ancillary derivative of that, they might care about people. But really, they care about banks. I mean, if you really cared about people, you would say, I declare that I want 0% inflation because I have a mandate from Congress for stable prices, not redefined as 2%. But why? Where did this 2% come from? And how did it get to go from 2 to 9? And why is it still at 3? And if you missed your target for 4.5 years, do you really even have a target? If you missed your target for 4.5 years and now you're trying to get inflation to go even higher, well, why? And the answer is they want to protect banks' assets. And what they hold are stocks, bonds, mortgage derivatives, bonds. And if home prices and bonds and stocks fall in price, these banks and investment banks, shadow banks, primary dealers go bankrupt. So the way to ensure that they never do is to always make sure that their assets go up in value. They're mortgage-backed securities, which are backed by houses, right? If houses are going up at a nice, they don't want it to go too high because bonds would revolt. But they want to make sure that their assets that they hold, mortgage-related bonds, which are backed by mortgages, which are pooled mortgages, which are backed by houses, never go in default. How do you do that? Make sure the home prices always go up. And sometimes they go up by 2%. And sometimes they go up by 20% year after year, like they did post-COVID. Oops. And now they can't, now the real estate market is frozen because people can't afford a house. But they're for you. The Fed is for you. They got your back.
Yeah, nobody in government's got my back. Let's talk a little bit about bonds. You mentioned that as well. And I think it's interesting, and you kind of touched on this, but I'd like for you to expound on it a little bit. And that's the fact that the Fed really doesn't have control over interest rates as much as they want us to think. Because if you look at the yield curve, the entire thing has gone up since they started cutting rates. So what is this telling us about the bond market right now?
Well, the bond market's concerned about two things. Like when you loan money, if I'm going to loan you, Mike, I'm concerned about Mike. Am I going to loan you, Mike Mahari, money? I want to know about. Well, what's your financial position? Are you capable of financing this debt? And if I loan it to you, at what rate am I going to get based upon your suitability to pay me back and inflation? Those are the two primary components. Well, we have a situation now in this country where we have basically an insolvent nation that just has given up on bringing prices into stability. So when that's the case, yields have to go up, prices have to go down for bonds, and yields have to go up. I mean, are you going to loan, like they were floating an idea of a 50-year mortgage?
Oh, yeah.
I mean, how in God's name are you going to price that out? A 50-year mortgage, I don't even know if we're going to have a currency in 50 years, much less be able to tell you, I'm holding that bond for 50 years for 6%. That sounds about right to me. I mean, I have no idea if inflation is going to be 6% or 106% in 50 years, right? So if you have an insolvent nation, with an intractable inflation problem that's going to get much worse, then your yield has to, the price goes down, the yield goes up for these bonds. That's it.
So if you're somebody that is, you're trying to preserve your wealth and keep it from dwindling away in this kind of inflationary environment, what do you do? I mean, it's almost like everywhere you turn, there's problems. So kind of how do you navigate this as somebody, like we recognize the problem, how do we shield ourselves from it to the best extent that we can?
Well, in stagflation, you usually turn to energy. I mean, nothing's guaranteed, but base metals, energy, precious metals, and short bonds. That's my, because I run money for a living. So that's what I'm going to do. I'm already short bonds. And it boggles my mind that people say, well, they think that the 10-year Treasury note is going to go down and yield up in price. Well, if it was yielding 4% when I shorted it, and now it's above 4. Well, we have 6% nominal GDP, 6% nominal GDP. So in what world would we have 4% 10-year benchmark? No way. So the only way that the yield is going to go down and the price go up on a 10-year benchmark Treasury bond is if we have a recession. And that's only for a little while, Mike, because if we have a recession, the deficit is going to go to $5 trillion per annum. That's my calculation. That's my best estimate as to where they're going to go, because they usually increase by 300% during a recession. And I have no doubt that that's exactly going to happen again. So the deficit is going to go from $2 to $6 trillion. But let's be kind and say $5 trillion. Well, who the hell is going to buy all that? Who's going to buy $5 trillion an annual deficit?
Yeah.
By the way, $5 trillion is 100% of our revenue.
Yeah, it's pretty crazy. I mean, I've talked to some folks, and I've talked about this. The fact that a lot of countries are starting to look at this, from outside of the United States, and they're starting to say, well, we don't want to get these, we don't want these treasuries anymore. You're seeing a pivot away in a lot of places. But then people will tell me, no, this isn't really happening. De-dollarization isn't real. Bonds are still. Do you think that bonds have kind of lost that safe haven status globally, or is it just kind of a blip on the radar right now?
U.S. Treasuries are backed by dollars, right?
Right.
So if our foreign creditors, the surplus countries, used to love parking their money in treasuries, they get a nice juicy yield, and the dollar was very stable. That was a pretty good deal. But then you have the fact that, well, our treasuries aren't really that stable anymore, and they're backed by a dollar that's been losing value. And the reason why that is because when you introduce capricious actions like sanctions and confiscations into the picture. Well, if I'm Russia and I'm going to say, well, I'm not saying it's not justified. Maybe it's completely justified. If I'm Russia or China or anybody else, and I have a lot of my reserves parked in U.S. dollars and treasuries, and the United States has a history of now capriciously imposing sanctions and confiscations on that money, and the interest rate I'm getting paid is going down. Well, maybe I'm just better off holding gold in my own possession, right? So I'll take my surplus. Okay, you're going to give me dollars for my stuff that I'm producing, and instead of buying treasuries and parking it at the Fed, what I would rather do is just sell your dollars and buy gold. And that's the calculation that's being made.
Yeah, and you can see that in the reserve statuses. As you look at the reserve mixes, you see Treasury reserves dropping, you see gold reserves going up. So that's exactly what's happening.
For exactly the reason I just mentioned, Michael.
But people still tell me de-dollarization isn't real, and I'm a kook for saying that.
Well, good for them. Tell them to short gold. Then that's wonderful.
Yeah, So, what do you think the ramifications are of the bond market becoming less and less appealing to folks, and yields going up and bond prices falling?
It's everything. It increases the interest payments on our national debt. So the deficit is going to go up. It increases mortgage rates because mortgage rates are pegged off the long end of the yield curve. It increases the corporate borrowing rate because corporations borrow at the long end of the yield curve. Most corporations do. So student loans, auto loans, some auto loans are priced off the long. So it affects the economy gets washed down the toilet when this happens. And again, there's not much they can do unless they want to impose yield curve control. So, another round of quantitative easing with a twist where they're just buying long-term debt and selling short-term debt. That's a possibility. I mean, but they have to do it in numbers that it can't just be an Operation Twist. It's got to be a massive expansion of the Federal Reserve's balance sheet, which is going to cause further erosion in the dollar and send inflation through the roof.
Yeah. I was told after the 2008 financial crisis that quantitative easing was a temporary program and they were not monetizing the debt.
No. So here's a little history of the Fed's balance sheet. So it was basically, a few $100 billion, actually $700 billion up until the end of 2007, $700 billion. The Federal Reserve printed $8.3 trillion at the peak. So from 2007, 2008 to 2022, $8.3 trillion. And that stuff, most of it is still on the Fed's balance sheet. Mm-hmm. Mortgage-backed securities and treasuries. Is the balance sheet now $6.5 trillion from $700 billion? So don't tell me they didn't. This is debt that's been permanently churned into money. It's been monetized.
So here's the question for you.
Never again will be in public domain. It's been taken off out of the marketplace and into the warm and loving hands of our Federal Reserve.
Ah, yes.
That money and credit is out there forever and ever. And that's why people are buying gold.
Yeah, exactly.
Going back, because it's going to happen again. We're going to go back to 9 trillion, probably double digits shortly. And by the way, and I know your audience understands, gold doesn't go up in value. But never. It's the beauty of gold. It's not even an investment. It's the perfect parking place. It's a placeholder of your wealth. Mm-hmm. So if you're going to retire and you have lots of money and you don't want to have your money diluted and your purchasing power go to zero, your standard of living you could keep your standard of living by holding gold because it keeps pace with inflation. So now if you want to actually make money, a real return after inflation, you can't get the gold is not your, gold mining shares maybe, but that's not an invest. So gold, that's what makes gold so beautiful.
Yeah.
It's the perfect store of wealth.
Yeah. It's a savings account, in effect.
Yeah, an inflation-adjusted savings account. Isn't that beautiful?
It's a beautiful thing. Here's a question for you, and this just kind of popped into my head. I'm curious what you think about this. So you go back to 2008. We had the 3 rounds of quantitative easing, at the time was unprecedented. And then we had interest rates at 0% for 7 years, and they never really normalized interest rates. You could argue that they didn't even really normalize them in this last hiking cycle. So we've got this entire generation of folks that kind of came into the financial world and into this business post 2008. To them, this is normal. Do you kind of see that thinking in younger folks that are out there in the world that, hey, 0% interest rates, that's fine. That's normal. That's what we're supposed to have. And just this kind of a lack of perspective in terms of like what interest rates would really look like normally?
Well, there was a time not too long ago when you got paid to borrow money. You remember that, Mike? For the first time in human history, right? I'm going to lend you money and then I'm going to pay you instead of me getting paid interest, right? That doesn't make much sense, does it?
No.
No. Well, it's actually a brilliant observation in your point. I've written about this extensively. So from the beginning of time all the way to 2000, we had something called a real interest rate. So not only was the nominal rate positive, but after inflation, it was still positive. And then from the year 2000 all the way to 2022, especially from 2008 to 22, those 14 years, it was negative and sometimes negative 8%. So if I can borrow money at close to zero in nominal terms, and inflation is running at 8%, I could buy anything and make money, right? What does that engender? That engenders a massive round of borrowing. That's what Blackstone did. I mean, borrowing money like crazy and buying large tracts of land and single family houses and renting them out to the poor, helpless, hapless population. Because, home prices are going up 20% a year and I'm borrowing money at 4%, 3% on a mortgage. It's a pretty easy calculation, right? So it distorts. This is the great distortion. And the more financialized, the more asset bubble ridden, the more inflation you have in your economy, the lower the real interest rate has to be. Because you see what happens if you have a real interest rate for any period of time, the economy collapses. Because asset bubbles don't burst innocuously. They rise and then they collapse. That's just the way leverage works. They're built on leverage. And when interest rates rise, you can't finance the debt any longer, and you sell it and you liquidate there's mass liquidation of your assets. And that's what causes it's a depression. It's not a recession anymore. It's a depression. If you look at how distorted things are, total market cap of equities, 220% of GDP. Yeah, that's a great metric too. Don't tell me about, the GDP doesn't count anymore because of corporations sell stuff overseas. Well, here's a factoid for you. Guess what? Foreign corporations manufacture stuff in the United States. That's why GNP and GDP run commensurate with each other. They're the same numbers. So that metric's still valid. And guess what? It used to be about 100% that was rich. Now it's 220. So we're in for a grand reconciliation of asset prices. It's going to happen. It's math. It has to happen. Same thing, home prices. Home prices don't belong, at over 5 times incomes. Should be closer to 3, but that's where they are. Yeah. And so home ownership is unaffordable. So what's the solution? A 50-year mortgage. No, that's not the solution. The solution is to allow prices to fall. Now, if you want to manage that fall as gracefully as possible, I can be sympathetic to that. But trying to reinflate the bubble, that's what's happening.
Mm-hmm. Yeah, I have this mental picture of the central bankers in their suits sticking their fingers in all the holes in the dams. They're trying to keep this. And it's interesting because you got the flip side of the asset bubble. You've got the debt bubble that has blown up over that time period, and everybody's levered to the hilt. Surprise.
That's what caused the asset bubble.
Right.
Asset bubbles don't happen on their own. They're engendered by low and negative real interest rates, which cause people to borrow a tremendous amount of money to invest in these assets. That's what happens.
Yep. Well, it's the world we live in, and like you said, we can't really change it. We have to cope with it. So before I let you go, I do want you to let folks know where they can find you and avail yourself to your information, or avail themselves to your information and your services.
Well, I have a weekly podcast called the Midweek Reality Check. It's $50 a year, and you get my take on the real salient information you need to know every week. And I give you a high-level summary of where I am in my portfolio. I have an inflation, deflation, and economic cycle model. It looks at the second derivative of inflation in the context of growth. I avoid recessions, depressions, sharp deflations, deflations and disinflations. I avoid those things, try to profit from them. I also want to avoid the hyperinflations too, and the stagflations, and what I think is more likely to happen first is a spike in long-term bond yields that wrecks this whole bubble. That's what I'm thinking is going to happen. Could be starting today. Mm-hmm. And if you're with your let's just one last thing. Oh, by the way, if you have 100 million, I'm sorry, if you have $100,000 and you're a U.S. citizen and you're qualified for a long short portfolio, I will take care of you personally in my money management service. Oh boy, I hope I didn't forget what I was going to say. Has something to do with spiking bond. Oh, so if you're good, I remember. Thank you, God. So if you're in your 60-40 portfolio, and you're like, well, I'm 60% stocks and I'm 40% bonds, And my bonds are a nice ballast to my 60% stocks. And my 60% stocks are all like AI stocks, because that's what you own if you own the S&P 500. That's what everybody's pegged against. So when the AI bubble bursts, like it did with Cisco Systems, lost over 80% of its value, even though the internet was a real thing. AI is a real thing too, but there's a lot of overinvestment in it right now. Right. So your 60% of the sleeve of your portfolio gets wiped out. And then you go, but I have 40% in bonds. But the reason why your 60% got wiped out is because your bond portfolio got wiped out, because your prices shrank and interest rates spiked. You're in a world of hurt. So you better be thinking out of the box here. You need to think out of the box, because we are way out of the box, historically speaking.
I like that. That'd be a good headline. We're way out of the box. What's your website?
Pentoport.com.
And you're out there on the Twitter, or not Twitter. I still want to call it Twitter, in the X sphere.
No, I hate social media.
You don't do that. Okay.
If you want to, I have a website, and if you want to contact me and my staff, you could. There's a contact page. Perfect. I don't want to tweet anybody. I don't want to go to any LinkedIn or anything like that. I just want to, I want to have a relatively small group of intelligent investors who want to make sure their retirement doesn't get flushed down the toilet. That's what I want to make sure. I take care of them.
That makes sense. And you probably save a lot of sanity and time and energy avoiding the whole social media thing too.
Yeah, I don't care. I don't care what you think about me. And I don't, I'm sure you don't care what I think about you. Not you. I mean, people say, oh, he's been saying this for so long. Well, you know what? In 2000, the market crapped out. 2008, the market crapped out. 2018, 19, 20, 22. Mm-hmm. I mean, these are periods of time that are predictable, and you want to avoid them. And so what? So maybe you don't care. Maybe it'll never happen again. You're wrong. I think I'm right.
Right.
And and by the way, I'm still long. I mean, I have a nice gain in the stock market this year. I have a model that allows me to participate in these bubbles, but tries to get me out and short when they change.
Yeah.
That's important.
Yeah, absolutely.
No.
Absolutely. Well, I really appreciate you, and I appreciate your insight.
Just one thing. Last thing I'll say.
Yeah.
Just because I don't like the foundation of the edifice, just because I could tell you that the edifice is fracturing and it's weak, doesn't mean it's going to collapse that day. It just means, hey, I'll go up in the building, I'll eat lunch in the building, I'll have dinner in the building, I'll have a dance party in the building, but I know that this thing's going to fall, and I know for the early warning signs when I can get out.
Yeah. You're not going to live in the building.
Not going to live. Perfect. Good job, Michael.
I'm good at analogies.
Very good.
All right. Well, I really do appreciate you taking the time to spend with us. And I like the fact that you give kind of a big picture overview of the things that are going on, because it's so important. As you say, this is the world of the edifice. I like that word that we live in. And it's important for people to try to grasp that bigger picture. So I appreciate that insight.
Yep. Thank you, Michael.
Have a fantastic day, and we'll talk to you soon.
Looking forward to it. Bye-bye.
Always love to hear Michael Pento's thoughts. Good stuff there, as we've come to expect from one of our best guests. Well, that will do it for this week. Be sure to check back next Friday for next weekly Market Wrap podcast. And remember to tune in as well to the Money Metals Midweek Memo hosted by Mike Maharrey. To check out any of our audio programs, just visit moneymetals.com/podcasts, or find them on Spotify, Apple Podcasts, Google Podcasts, or wherever you listen to your favorite podcasts. And as a big help to us, we would ask that you please like, subscribe, download, and rate our podcasts. Doing so helps us extend the reach of this material. Until next time, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a wonderful weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes. For answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds, call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by to answer your call during business hours, Monday through Saturday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, Visit us at www.moneymetals.com or call 1-800-800-1865.